Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational trading webinars. We are happy to have Vlad Karpel here this afternoon for another iteration of options trading on your lunch break. He is here to talk with us all about specific option strategies to set up higher probability and defined risk trades, just designed for markets like this that we're in today. So we are thrilled to have him back. I believe we also have Keith Harwood here to provide additional insight. Vlad, Keith, are you with us?
Yes. Can you guys hear me?
Hello. Yes. Hi to you both. And Vlad, nice to see you. Thank you to everyone who took time out of their afternoons to be with us live. So Vlad, whenever you are ready, you can go ahead and take over screen control and pull up your presentation. Just a reminder to those with us, if you have questions during the presentation, please feel free to type those questions into the chat box or the Q&A, and I can get those over to Vlad and or Keith to address. All right, Vlad, I can see your title page, so feel free to get started when you're ready.
Perfect. And you guys can hear me?
Yes, we can.
Perfect. Again, thank you, Natalie. Thank you, AGT, for hosting the webinar. Super excited to be back. And today we're going to continue our conversation on options trading. Right? We'll touch base about probability of success, weekly options, time horizon. And today we're going to start talking about just specific strategies. The most basic option strategy would be put and call. So, if you're new to trading options, I would encourage you to type in, if you can type in and just let us know in terms of if you're trading options or not. And then if you are trading options, how long you've been trading options. And then based on the audience and the feedback, I can spend more time on basics if you never heard about options or never used them. A lot of people are afraid of trading options. They sound complicated. Hopefully after today's presentation, you'll feel a little bit more comfortable about trading options. And if you are trading options, just let me know how long so I can just figure out, maybe cover a little bit more advanced topics. In terms of my bio, again, for those of you who are new, welcome. I've been trading for over 25 years. My background is technology. I worked as a CTO executive in several startups, fintech startups here in Chicago, Options Express, Pick6, Groupon, and several others. So my background is in technology, but for the past probably over 20 years, I've been managing my own money using the technology that I've learned at hedge funds and trading to take advantage of market opportunities and build a system that can help me trade. So that my background is artificial intelligence, trading, and technology. And then more than a year ago, probably almost a year and a half ago, we have Keith who joined us from Options Hotline. And Keith, you want to give a few words about your background?
Yeah, absolutely. So I started as a market maker down on the CBOE floor back in 2005, traded through the subprime crisis. From there, went and traded as a proprietary trader. Worked with managing portfolios in gold, silver, European bonds, CTA, commodity-based hedge funds, so learned a lot about technical trading. But my main expertise has been focused on a lot of options analytics and technical analysis. And so happy to be working with Vlad and taking advantage of the really powerful artificial intelligence tools that he's used to really help accelerate my trading and kind of share that knowledge of options expertise, AI expertise, et cetera, that I think we really work well together on a lot of this stuff. So it's been a lot of fun here over the last year and a half working through a lot of these ideas.
Yeah, definitely a lot of fun, and I enjoy our sharing the experience and sharing with you guys. Disclosures, I'm going to go through specific trade setup, trade ideas. So it's important to understand, especially if you never traded options or if this is the first time you see these disclosures, it's very important to understand the risk and suitability associated with trading stock or options. I encourage you to visit this link on my screen, optionsclearing.com, at some point and just read over the disclosures so you can understand the risks that are involved. But, in summary, I'm not a registered rep. I'm not registered with FINRA nor SEC. I'm here to show you what I do in my own account based on my own risk tolerance level for general education information purposes only. And, so that's the gist. Options. So I don't know. Let's see how many people reply. Beginner, been doing some research. Chuck Hughes, option engineer. I have traded options for about 8 years. Okay, so you have different background. That's great. I'll try to, maybe spend a little bit time go over the basics and then maybe do some more advanced topics, especially if you're trading spreads for 8 years. So for those of you who are new to options, options is a financial contract, basically gives the right, but not obligation, right, to buy or sell underlying asset at a specific price or before a certain date, right? So options are just like stocks, they're security associated with specific value, and they are binding contracts with clearly defined terms and properties, right? So I always think about options as basically a derivative of underlying stock, and they're correlated to that derivative. But I always think about options as kind of an insurance, right? And that's how it was originally created for. Options were created so you can hedge your assets, your stocks, right? If you're buying a stock and you want to make sure you hedge or you know what your downside risk, then you can buy puts. And then you can also use it as a leverage. You can buy calls if you think that the stock is going to go higher, right? So some examples. So I always think about the house, right? This is one of the examples I use. Some of the students like that. If you're renting a house, right, or if you want to sell the house, right, sometimes we give, as a landlord, you can give an option to a tenant or to buy the house, right? They can rent it for a year, and if they don't have money right now, they just want to see the area and then get used to it, they can rent for a year, and then you can give them an option to buy the stock, right, when the 12 months lease is over, and then you would require certain compensation, right? But the tenant could lock the price, right? If the house right now is cost $250,000, a year from now you don't know what the cost of the house will be, but you're given the right to the tenant to buy the house, right? And you're charging, either extra rent, or you basically say, well, for that option that you have the future purpose, then you charge $5,000. Right, so that's an example of a call, right? Example where you have a right to buy an assets in the future at a certain price, right? Like a house, or it can be a stock, like Microsoft. And if you're a landlord, right, you also go to insurance and you say, in case something happened to my house, some kind of natural disaster, or, fire, flood, I want to make sure that I get an insurance that my house will never cost less than $250,000. I'm insured for $250,000. If for some reason there's a flood and the price of the house is now $220,000, insurance will pay me the difference, right? But for that, I have to pay monthly premium or annual premium, right? Monthly payment or annual premium that I will pay to insurance. And that will be an example of downside protection, such as a put. So something to keep in mind why options are, complicated is that unlike stock, there are different characteristics, right? You need to have a time horizon, for a year. Let's say my time horizon, I want to rent for a year, and then I want to buy a house, okay? Or my time horizon, every month I want to buy insurance. So there is a time, the concept of the strike price. At what level do you want to insure it or buy the house? And then there is a time horizon, right? Expiration months. But just keep in mind that options are derivatives, right, of underlying stock. Not a good word. I always think about my calculus classes, and that wasn't fun also. But it is a derivative of underlying asset class, and it's something to keep in mind. So two types, right? I kind of quickly went over two different examples, and please type questions. I want to make sure that I do get a chance to answer any question we have.
No questions so far, just commentary on where
Just
people
commentary.
are at with their experience.
Perfect. Thank you. Appreciate it. So two types, calls and puts, right? So usually I just remember one. I remember when I first, in college, when I was learning about options, I kind of just learned one, and then I can figure out the other one is opposite. So you can think of it as an insurance, then that's a put, right? And it's always kind of a downside. Then the other one, the call, is the upside. Or you can think about a call, right? The upside, where I can buy a house for $250,000, but I can delay the purchase for a year, right? But, with the hope that the house will be worth a lot more than $250,000, right? Because of the inflation or because of your view on the economy. So that would be example of the call option. The put option is in reverse, right? You think, there's a chance that you live in an area where you get flooded, so it makes sense to buy an insurance, right? Because you think something's going to happen to your assets to the downside. So that will be an example of the put. But already gave an example of a strike price, right? You value your house at $250,000, so that's the premium you will be insuring, right? That's the level. When you have stocks, there's stock have prices, right? They trade, and then you want to make insurance for certain, 5% downward, 10% down protection. And then for each of, depends on, what level you're insuring your stock, you pay a different premium. But strike prices are important to selection. That's what makes it complicated, that you have to select, time, right? And you have to select the direction of the movement of the stocks and then the magnitude of the move, right? So it's kind of going back to your physics class, you have to look at the three vectors, right? Three characteristics, direction, magnitude, and time. So the approach is usually when you trade stocks, profit loss is just a linear relationship, right? You just, you buy a stock at, $103, if it's currently trading at $103.46, you think it's going to keep going higher, right? You buy Nvidia because of the AI, or you buy Microsoft because of the AI, or buy Bitcoin because it's, the future, digital currency, because you think this asset class will continue to appreciate. So the chart looks like this, just a straight line, right? In case you're wrong, it goes in a different direction. This is, the maximum loss is this example, $103.46, if that asset is worth nothing, right? For options, right? The idea is if you need to address if you have a smaller account, right? Or if you want to leverage your account, right? Let's say if you want to buy 100 shares of the stock at $100, you have to spend $10,000. What if you don't have $10,000 and you want to leverage? Just like when you buy a house, maybe you don't have $250,000. You don't have 10% down payment, but in a year from now you will, right? But you want to kind of lock that price, right, of the house, because you think the inflation is going to continue and the house prices are going to continue going high, right? So the idea of, you leverage, you want to capital. Sometimes you use options to lower your cost basis, right? To lower your cost basis than the prevailing market. And you structure your trade with, you want to structure trade where your probability of success is greater than 50%, right? And limited risk, right? Instead of a $100 stock at 100 shares, that's $10,000. If you don't, and in theory, if you don't have an insurance and the house disappears for whatever reason, then you lose everything, right? What if you don't want to risk? You just kind of want to live in the house for a year, pay the rent, and then not worry about that the house can go to zero, but still have that right to buy it, right? So that gives you that limited risk for the options. So as you can see, profit and loss is a little bit different for the call option, right? You select certain strike price, right? In the case of a stock or the house, the previous example was $250,000, right? Or in case of the stock trading at $103, maybe this is a $100 strike price, or 105. This is a level at which you either want to insure your asset class, for example, for puts, or you want to lock the future price, right? So the profit loss, basically what it shows is that you have a limited losses, right? You have limited losses. You buy a put, you buy a call, you buy that insurance for the house. That's the most you can lose, right? Because the insurance is obligated to pay you the full amount for your house. So the only thing you can lose is if nothing happens, which is great, then you just lose the premium that you paid every month for that house, right? So that shows you how much you can lose for call. But if the house price continues to go higher from 250,000 to 160,000 to 170,000, well, then if you bought a call, then you're making money, right? If this asset appreciate and you bought that call, you bought that option from the landlord to lock your purchase price at $250,000, then you continue to make money. We touched base on the probability of success and probability of profit. So let's go over some of these examples, right? So we already saw that the profit and loss chart for the calls, right? This is a long calls. I did this a couple of days ago. Spiders was at 667. Basically, the price of this option is $6.20, right? Is there a pen here? Should be a pen. Let me see. Share. Annotate. Yep. All right, so this is $6.20, right? This is how much I'm paying for this call because I think Spider is going to continue going higher, right? At that point, Spiders were 667, right? And I selected a strike price, 674 call. Right? So I bought a 674 call, right? So, and this is my maximum loss, is how much premium I paid for that option, which is $6.20 times 100, so $620. So that's my maximum loss. And then if the stock continues going higher, spiders actually were going higher, right? Then I would have made money. But because right now spiders are actually, last time I checked, was 660, then I'm losing money, right? I'm losing money, but I know my maximum loss is the premium that I paid, $620, right? And the expiration was, I selected October. Day still expiration 25. So I basically have a right to buy spiders at 674 until October 17th, right? And if the spiders jump to 670, 680, right, then this trade would be profitable, right? Assume, but something to keep in mind is time decay, right? Also time decay, right? Because the $6.20 is kind of acting as an ice, right? It's melting. If the stock is not going anywhere, if the spiders is kind of glued to this 660, 667 level, then every day I lose time premium, right, for this option because it's out of the money option. So that's an example of the calls, right? Profit and loss. Let's say I was bearish, right? We already have decision on the rate cut, 25 basis points rate cut decision, and 2 more rate cuts this year. AI, we have initial claims today were better than expected, but the market is reversing, selling off because, Warren Buffett indicator got triggered yesterday, and we're at, multi-decade high evaluations for the stock market, and there's still risks because of the tariffs and because of the, inflation is still not at 2% and looks like unemployment could tick up higher in the next few months. So then you want to do the opposite trade, right? In this example, I'm buying 660 put, right? And this was a few days ago when the stock was at 667, right? Because I want to hedge. Let's say I have 100 shares of spiders and I want to hedge till October 17 in case, market does pull back. Then I'm buying 660 put. I paid $5.88. And here it's the opposite, right? This option is going to increase in its value, right? It's going to increase in its value as long as the stock continues to go lower, right? If the stock continues to go lower, I bought a put, right? And that insurance, it basically locks me into that I cannot, if the spiders is going to be below 660 like it is today, right? The last time I checked, I think it was slightly lower. Then, the most I can lose is the premium. I have an insurance till 660 level, plus the premium that I paid, right? Plus the premium that I paid. But if it drops to 650 or 640, right? If the pullback is deeper than 655, right? If let's say we get to the 50-day moving average 650 or 645, then this is when I'm going to start making money, right? You have a break-even point. That's your strike price plus premium, right? I selected 660 strike on spiders. There is some time premium, right? Extrinsic value, $5.88. But anything below basically 655, and then I'm start making money. And you can see probability of profit, right? I'm buying out of the money options, 30%, right? So this is why, options do have sometimes negative connotation where people say, well, every time you buy puts and calls, you lose money. And it's true if you buy in puts and calls, right? If you buy and puts the calls and out of the money puts and calls, you can see what the probability of success, right? So 30% of the time, this trade would be losing trade, right? But for puts, if I want to hedge, right, I don't mind losing $5.88 if spiders are going to be at, by October expiration at 680, right, or 690, right? If I think the bull run will continue and an AI revolution is here, then I don't mind losing the hedge that I implemented, right? You can lower this hedge by doing the spreads, right? I can buy 660 put if I don't think the stock market is going to sell off below 640. Okay, then I can sell 640 and lower the cost basis of that insurance. But that's kind of a more advanced strategy. But that is something that you always want to look at, probability of success versus return on capital. And when you buy an out of the money options, unless you think, most of the time, 30% of the time, it will be losing trade, right? It will not be losing trade instead of puts. If you have an opinion that in the next few weeks, the market will pull back to 50-day moving average, right? Because you see that Bitcoin is falling apart, VIX is jumping to 18, interest rates are volatile, Nvidia is selling off. So then you're concerned and you want to hedge your portfolio, then you buy a put. But you have to be correct on the time, right? You have to be correct on the time, and you have to be correct on the direction, right? And the magnitude of the move, right? You have to be correct on the magnitude of the move. All right. I know I covered quickly and a lot. I know a lot of people, especially if you knew, this is a lot to digest, right? Derivatives and time, magnitude, vectors, all of that could be overwhelming. So if you guys have any questions, and I'll turn to Keith. Keith has a lot of opinion and he has a lot of experience about options. He's been doing this for a very long time. So Keith, I know it went quickly, but I'll be happy to hear your thoughts.
Yeah, I mean, I think for me, the biggest thing that a lot of people, you know, fail to recognize is that probability of profit. Really, that's the biggest thing for me. I mean, when you look at buying a call or buying a put, it's no longer a 50-50 bet. Even if you get the direction right, you can get a situation where you lose money because it doesn't move enough or it doesn't move fast enough. So just because the market goes up doesn't mean a long call is going to pay off. So always keep that in mind when you're executing a long call or a long put. You may actually have more losses than originally expected, even if you're getting the direction right. And that doesn't mean your strategy is wrong. It's that leveraged payoff that's going to offset that lower probability of profit when you're really right. So that's a huge element that I think a lot of people kind of get stuck on is, I thought I had it right, but then the market only went up from, in this call, the currently trading 667. We rallied to 675 or 680 even, and end up losing money. And that can be a painful experience. And it's a reminder that, that there's the magnitude of move that really matters.
Perfect. So thank you. I'll spend a little bit more time maybe on more advanced topic. So how do you determine direction, right? Or, I'm looking at SPX, right? It's hitting 20-day moving average. We had 3 days of downward price action. We actually broke through the 6,600, right? You can look at you've seen this presentation before or this chart. I'm looking at the SPX, right? A lot of it has to do with positioning, right? These strike prices, these levels at which people are buying spiders hedge. You can see the highest positioning is at 6,600, right? And this is what is called put wall, right? And right at that level, 659 is where the gamma flip is, right? So we briefly trading right before that gamma flip, right? And you can see we're ticking below 6,600, right? Below 6,600. So now there's two school of thoughts, right? You can say, okay, if you're confident, right? If you believe that we broke through the 6,600, right? And we're going to stay, let's say we close at this level, right? We're today's session low was 65.74. If you think this is enough for the past 4 hours, bulls cannot get above, cannot close the gap. We're going to close to the, we ending up, drifting lower towards the end of the session. And you think there'll be continuation in the next few days, that we're going to go to 6,500, because really, if the 6,600 level doesn't hold, right, this is open interest bar. One of the very important concepts in trading is, we talk about game theory, what other people think, right, or how other people are positioned, right? It doesn't matter what Keith thinks or what Vlad thinks. What matters is what more than 51% of the people think. So you can see a lot of people are hedged at 6,600, and if that level doesn't hold, then the next level is 6,500, right? Which happens to be close to 50-day moving average, right? Close to 50-day moving average. So if your opinion that, maybe government shutdown, right? People are concerned that by the end of September, Democrats and Republicans cannot find a common ground, and there will be a government shutdown. A lot of people will be unemployed, will take, leave without pay, and maybe it's not going to take 1 week to resolve the issue. Maybe it'll take a month or two. Again, black swan event. We haven't had a government shutdown for a very long time, and if we did it, usually there is an agreement reached. But maybe you're concerned and you want to hedge, right? And you already see symptoms where Bitcoin is falling apart, right? You can see Ethereum is falling quickly and Bitcoin is falling quickly to the downside, breaking major levels, and you're concerned, right? You're concerned that we're going to stay below 6,600 and you want to do a hedge. So then you would do this trade, right? You would buy a put, right? You would go trade option chain. This example of Avant-Garde, you can trade somewhere else. But usually you select the underlying assets, spiders. Then you select, your time horizon. My time horizon, usually you look at monthly expiration, October, you might want to say November expiration, but Keith likes October expirations. I do too, if I can only find it. So here we go, October 17, right? So I'm basically, but somebody's on the other side is selling me this right? Let's say I'm concerned about 660 level, right? Or maybe I want to hedge at least till 650 level, right? That 50-day moving average. So I can buy 650 put, right? It gives me a hedge till October 17th, next earnings cycle. Maybe government shutdown, maybe, China and United States cannot agree on a TikTok deal. But once October expirations, October starts and next earnings cycle starts, I think banks can benefit in lower interest rate environment. Small caps can benefit from lower interest rate environment, and the bull market will resume once the earnings cycle starts. So I pick October's expiration. If I want to give yourself more time, go to, let's say, November expiration. Well, you can see I have to pay more premium. The longer I want, then the higher the premium that I have to pay. And that basically gives me 100 shares of S&P. And if it drops below, in this example, 650 put November, it's $11, right? So my break-even point is right below 640, right? And I would only do this, right? It's a low probability trade, right? 20 to 30% probability trade, but it only if I think, right? If I think I'm concerned that 50-day moving average doesn't hold, right? And if I'm concerned, or I have a precipitous drop. It doesn't have to drop to 650, but maybe it drops to 655 very quickly, right? Because this level 6,600 cannot hold. Then I could, if the time decay, if the stock drops faster than there is a time decay, then I can also benefit from this trade, even if it doesn't get to the 650 level, right? So that's an expression of the one way to think about it. The other one, you can say, Vlad, nobody knows anything. I see a lot of support at 6,600. The positive gamma flip, 60 also is at 6,600. That means that the dealers have to be market neutral. They have to step in and buy the stock. And I think market is oversold short term, and I think it's going to bounce, right? Then you take the other side of that argument, right? And instead of buying a put, you basically say, well, I think we're going to be at 670, right, by October. right? Or I think it's actually going to be 680 as the new earnings season starts. So I want to buy on it, every time the stock market drops. So then you say, okay, I'm buying a call because I have a bullish view, and I think by October or November we will be at 680, 700, right? Goldman Sachs, Bank of America, already put out, UBS put out estimates of, some of them are close to 7,000 by end of the year. So if you think by end of the year we're going to be 7,000 and these pullbacks are going to be shallow and short-lived, then you buy the dips and you buy 670 call. Again, you're risking $10 times 100, so it's $1,000 risk. But that's the most you can lose, so it gives you leverage, right? But if you're right, and in this example the stock market is actually going to break 680 between now and end of November, right? Usually end of October, end of November is very bullish from seasonal point of view. And if you think it can get to 680, 690 level, then this is a way where you would, you risk $10 and your gains are unlimited, right? If it gets to 700, 710, then you can make money. But again, it's a trade where the stock, you have to be correct on the time and direction, right? And unless you think there's a catalyst in the market to drive to 700, then 30% of the time you're going to lose money, right? You're only going to make money if you're going to be correct that there is a catalyst in the stock market, and even though stock market is overbought, but earnings are going to be double-digit growth, and new administration will sign deals with all the countries on tariff, right? So that's kind of gives you perspective for two separate trades and how you can structure them. And you can always refer to this chart, right? To the here you can go. Let's do spiders, right? And let's say I want to do long call. And I'm going to select, let's do October expiration. And I want to buy, what did we say, 700, 670? 670 strike. Yeah, so then you can, same thing, you can look at the probability of success, 30%, 21%, right? So 70% of the time you're going to lose money, right? Unless there's some kind of a positive catalyst. And in this example, I went to October, you risk a lot less, $3.72, right? So your maximum loss is $372, but your maximum profit is unlimited, right? And if you want to structure a trade to hedge your existing portfolio, then you can also look at right, you can switch to long puts, right? I want to hedge till maybe 650 put, click. Okay, 30% probability of profit. There's a time decay, right? Every day you have, if the stock doesn't go anywhere and you don't have that positive or negative catalyst, then the premium is going to disappear. Not disappear in one, slowly disappear and start accelerating the time decay as you approach closer to expiration. Any questions?
Yeah, thanks, Bud. We did have one question coming in from Steve. Just generally kind of asking, are there any differences in the risk parameters for certain times of year, small cap versus large cap, certain sectors? Obviously you can't recommend any sort of specific stocks for trading, but just generally speaking, sounds like you're trying to get a handle on just the overarching risk parameters.
Sure. I mean, there's different ways to look at the data. I'm kind of a top to bottom approach. I do look at interest rates, right? So if I go and look at the 10-year yield, right, I can see it's moving down, right? And Fed already penciled in a few more rate cuts. So if the interest rate's going to continue going lower, right, and Fed is going to continue, especially as Powell leaves in May and there's new administration, somebody's going to manage who is more dovish and start lowering interest rates, then in a lower interest rate environment, then it benefits stocks, right? It benefits stocks. So you ask about small caps, and small caps could benefit from a lower interest rate environment, and that's why you see since the Liberation Day, day one or part one, small caps just continue going higher. interest rates are going lower. And if that persists and there is no signs of recession, then the small caps will move higher, right? So a lot of asset classes are dependent on the interest rates, and you gauge the risk based on where the interest rates are going, right? From macroeconomic perspective. And then I do look at the dollar, right? Weak dollar benefits emerging market, right? If you have a lot of debt in US denominations, then lower dollar is beneficial for S&P 500 companies that have exposure to outside of the United States, but also emerging markets, right? So emerging markets are beneficiary of a weaker dollar, and that's why you see industrials, banks are doing better, right? Banks are doing better in a lower interest rate when the yield curve is normalizing, and industrials are doing better. So industrials, banks, technology, AI, they're all, the long-term trends are intact, right? And should benefit in low interest rate environment. The unknowns, the risk, obviously, tariffs, right? Inflation, and potentially rising unemployment, right? And in terms of seasonality, in terms of timing, yes, there is this, I wouldn't make a decision just pure on seasonality, but you can see, you turn on Bloomberg, CNBC, they will say September is the worst month to invest, right? Usually it's a negative return. October, November, much better, right? If you look at spiders. But I would not make a decision purely based on the time of the year. But the seasonality does have impact on oil. It does have impact on, healthcare stocks. So there are definitely some correlations to that.
Great, thank you, Vlad. Yeah, it's a good point to make that there's not just one consideration. Don't throw all your eggs in one basket. To kind of look at the whole picture and assess what works for you. So thanks, good feedback.
Keith, anything to add?
No, I think just the one thing that I may have caught from that question as well is in terms of best stocks to be able to actually execute option strategies, factoring in liquidity can really help a lot as well. So when you're looking at large cap stocks, big names, they're going to tend to be tighter markets, give you better entry and exit prices. When you look at small caps or infrequently traded stocks, you're often going to be paying a big spread to get in and out of the positions. So particularly when you have a bearish environment, staying with some of the bigger ETFs can be helpful in that scenario, going with SPY or IWM or QQQ rather than going into illiquid individual names.
Yeah, thank you. I think Steve asked the question in terms of certain sectors or certain stocks to trade the options certain time of the year. I think for me, one of the not requirement, but nice to have is liquidity, right? That the bid and ask is tightly spread, and then you have enough people participating in trade, so you can look at, let's say, gamma exposure, right, or open interest, and there's enough liquidity to provide support for these asset classes. Because if it's a liquid options with a very wide bid and ask spread, right, that's where you're losing a lot of money between the wide bid and ask. So in generally, you want to trade liquid names where there are a lot of people participating, and you have high open interest at different strike levels that can give you some kind of an indicator where the support and resistance should be. Right, but small caps versus mid caps. This is your view on the interest rates. This is your view on unemployment, right? And most macroeconomists, they could be right on the direction, but most of them are wrong on timing, right? Everybody predicts the recession, but usually it's to time the recession very difficult, if not impossible task, and it's usually in the rear view mirror you can decide whether you were or were not in recession. And then in terms of question, do I have to have $250,000 in account in order to buy a call? No, right? The idea is that when you rent, you don't really have to have $250,000. So when you buy a call, you don't need to put up the capital. The only caveat is the biggest thing that you do want to be concerned about when you trade options is if you get assigned, right? Because if you buy this call and that you're approaching to your expiration date, right, in this example for October, and you have in the money call, right, let's say you bought 670 a call and spiders at 680, you could get assigned, right? You could get assigned. So this is, you always want to be concerned with assignments, especially, if you don't have the capital and the next day after the assignment, the stock goes in a different direction. Then you have more risk than just the capital that you put up for the option. So great question. You don't need to have a capital. You don't have to have $250,000 if you want to buy a house, right? Rent the house was the option to buy it in a year. But in the world of options, you could get assigned, right? You could assign earlier. And if you do get assigned, then that's where the risk is. So if you have a smaller account, you want to avoid assignments, right? So as you approaching closer to expiration and you have in the money option, you want to either close it or roll it into the next months. Issue feedback call, you have the right, but not the application. Right. Call, you have the right, not obligation. But again, if you get a sign, then you will have to, put up the capital. So just avoid the assignments. Tom, thank you. Any other questions?
Thank you, Vlad. Thank you, Keith. Yeah, if you want to go ahead and put your contact slide up there, Vlad, so everyone can. Yeah, great. Thank you. Justin, in case there's any more follow-up questions about Vlad and Keith's specific presentation here, you can reach out Vlad directly. He's got the email and phone number. Please feel free to write that down and reach out to them with any follow-up questions. Really great questions today and engagement from our live audience. I really do appreciate it. And thank you to Vlad for putting the presentation together, and for Keith for helping answer some questions and provide his unique take on the questions as well. I'm going to take the screen back. Just as we wrap up here, remind everyone to check out tradeagt.com, our Avant-Garde trading website. Look around there, take advantage of the free membership pricing through the end of the year. Go ahead and sign up today, open your account, reach out to the team, the numbers on the screen, and get your questions answered. Another question just came in. Yes, we are recording this afternoon's presentation. So if you came in late or you're not with us live, as long as you registered for the webinar, you will go ahead and get an email sent to you later today or tomorrow from info@tradeagt.com. It's going to have a link to the recorded replay of today's presentation, so you can rewatch it at your leisure. You will not miss out. Vlad, Keith, thank you again. We'll have you back soon, and thanks to everyone who joined us today. Good trading to all.
Thanks a lot. Thank you for the opportunity.
Thanks, guys. Bye-bye.